Hi everyone, this is Victor Colella, and I'm a financial planner here at Advisor Investments. Welcome to another Advisor You Can Talk To podcast. Our topic today is resolutions. It's that time of year. Specifically, though, we're talking about financial resolutions, not spending more time with your kids, improving your eating habits, or even reading books, but we're talking about getting your financial house in order. So we're going to give you 5 easy to follow, hopefully, but very important financial resolutions that we think could get your year and perhaps even your financial future started out on more solid footing. Today, I'm joined by 2 colleagues of mine. I've got Josh Jones, who is a vice president here in Advisor Investments, and he serves our clients in a relationship management capacity. So he helps individual clients achieve their financial goals and do these sorts of conversations on a regular basis. On my other side, I've got Andrew Busa, who you all know and hopefully love from prior episodes, and he is a financial planner who I work with in our central planning group on a regular basis. So let's kick things off. I'm going to jump right in with the first resolution. Our first financial resolution is to understand your spending. It's important for a variety of reasons, but really we want to say it's not important to stick to a budget dollar for dollar or know where every dollar is going. We're focused on sustainability with this one, but also making sure that you know what you spend at least enough to understand how much you're saving or how much your money is going to last in retirement. So what do you think, guys?
So, Victor, the way I think about it, and this might be a little unusual, especially to hear it coming from a financial planning firm, but to invert it. In other words, instead of focusing on your budget or your cash flow or where is all my spending going, immediately save 10, 15, 20% off the top. So you know, for example, if you're saving 20% off the top, you're putting a ton of money away on a regular basis. It's sustainable because you're not looking closely at what am I spending every month. And I've just found over the years in working with individuals and families that by inverting it, as we like to say, it allows them to stick with the long-term savings plan.
Yeah, Josh, I do like that approach quite a bit, especially if you're in the middle of your working career, you're accumulating assets. I think thinking about it that way makes a whole lot of sense because savings towards your retirement goals, your short, medium, long-term goals, that's what's probably most important to you financially right now. So if you're hitting that, 10, 15, 20% savings number, then you're good. You don't have to worry as much about what you're spending. But if you're approaching retirement or you're in retirement, I think it becomes a little bit more important to actually really understand your expenses, maybe live on a budget because, let's face it, you aren't saving anymore, right? You now don't have a regular paycheck that you're receiving. So you need to understand more really what you're spending.
Well, that's true because retirees, and we work with a lot of retirees who are running financial plans to say, how long is this money going to last now? And you unfortunately can't take that same approach of figuring out what you're saving at that stage. But it is sustainable. I mean, everyone said at the beginning of the year, I'm going to go to the gym 7 times per week, and then you get discouraged after the second day where you missed. It's the same idea with a budget. Everyone's probably tried to make a budget and fallen off the wagon. So keep it as simple as possible, but in retirement, that may mean actually making it sticking to a budget. So best way to get started here is figure out what stage. So if you're still working and saving actively, maybe you take the more simple approach, but figure out what stage you are and maybe look at a month's worth of expenses instead of thinking, how much do I spend in a year? It's a little bit easier to think of a month, which is 4 weeks of spending, than it is to think of a year. So don't sweat the small stuff. Don't get discouraged. Keep it as simple as you can. All right, so our next resolution, the second resolution, is be systematic about planning your cash flow for the year.
Yeah, and this one ties back into our first resolution of understanding your spending because we're going to have you look out over the next 12 months and think about whether you have any large one-time expenses coming up. Maybe you're thinking about buying a car, taking a big vacation. Maybe you're putting a down payment on a house. These are big one-time goals that you should start to think about and plan for. And that short-term money you're going to be using in the next 1, 2, 3 years really shouldn't be invested aggressively. Once you figure out those next 12 months, think about, is there a gap between what you have to meet those goals and how much that goal is going to cost?
You make a great point. Long term, investing makes all the sense in the world. You're buying good businesses and holding on to them for a long period of time. Short term, the markets can be totally random, and psychology, I think, plays a big role. So the last thing we ever want any families that we help to have to deal with is selling a stock or selling an investment that's temporarily down in price. So that's why it's so important to have your cash reserve separate from your investments.
Yeah, and that's easy to forget after, a long market that really only goes up for the most part. So I think when in times of volatility in the markets, it's a quick reminder why that rule of thumb sort of exists. And then if you do have a gap, so if you have a gap in the amount of cash you have available for the next 12 months, you do have options other than selling a temporary down investment. Sometimes you can use debt to temporarily bridge the gap, so either a home equity line of credit or different debt sources like that. You could have a yard sale, you can cut your expenses. You do have a lot of options. So first step really here is talk it out with your family. Think about what the next 12 months look like. Josh, you have a client who does this. You said you can expect a call in the first week of January each year.
Yeah, it's really important to them as it is to us to understand what the needs are as far as cash flow for the year are concerned. So there's a family literally the first week of every year. Number of families have this conversation with, and it's important.
Okay, number 3. So our third financial resolution is cover your risk. So it is a dark time of year in January. A lot of people have some depressed energy around, so let's channel that to thinking worst case scenario. So risks are, it's a good time of the year to think about, what could happen. So if you lose your job or if the worst happens, so you sort of get sick, hurt, can't work, or get hit by the proverbial bus, we're talking about making sure that you've got your emergency fund sufficiently built. So a good rule of thumb is have 3 to 6 months of expenses, basically sitting in a bank account that you can access in a couple days. It's a good time to check your credit report. Make sure that nobody is fraudulently accessing your credit. So you can go to annualcreditreport.com here, or you can set alerts with many of the agencies. What else? What am I missing?
Victor, another really important topic is estate planning, and it can sound complex and feel a little overwhelming, but at the crux of it, estate planning can be really simple. And it's things like, do you have a basic will, God forbid something happens, or other documents like a healthcare proxy or powers of attorney. The other thing that I think is really important is making sure on retirement accounts or even individual accounts that beneficiaries are up to date. Because what a lot of people don't realize is that beneficiaries on retirement accounts take precedence over a will. So just a couple of simple things you can do to make sure you're up to date.
Yeah, we have way too many stories of folks who we're doing a financial plan and we take a look at their beneficiaries just to make sure everything is tight. And we'll see an ex-spouse or a sister or brother who, was the beneficiary before they had children, and they had no idea that it was the case. But if anything were to happen, it doesn't matter what their will says if that's updated. It's all up to the beneficiaries. And then finally, I just do want to mention, maybe it's a decent time to pull out those homeowners, auto, life, and disability type policies. It's tough reading, and it can be overwhelming, so pace yourself. And just make sure that you have the coverage that you would need should the worst case happen. So a good way to start here is take a look at that emergency fund. How much do you have available? Get your credit report. Take a look at any activity. You can help identify opportunities there to improve the report as well. And then make sure your insurance beneficiaries, your retirement account beneficiaries, and your estate planning documents are all in order. The fourth resolution is, this is a quick one, but it's take full advantage of your tax-advantaged opportunities. So these are gifts from the IRS.
And in case you missed it, the IRS recently announced increased contribution limits for retirement accounts, and we'll be releasing a key financial data piece that will list all those specific numbers for every account. But the IRA contribution limit has actually been raised for the first time since 2013. So we wanted to make sure you're aware of these. Another thing to keep in mind here is it's not too late to contribute to last year's retirement accounts under the 2018 contribution limits. So, you can look at your Roth IRA, your traditional IRA. You can still make contributions under those 2018 limits. You also may be able to contribute to your 401k under last year's limits, depending on your employer plan. Another thing here is your FSA, right? Your flex spending account.
I was going to say not just your retirement account, so your health savings account, as well as you may have money from your flex spending account that you can still spend in the first couple of months of the year. So make sure if you've got money left, don't let that, because remember, it gets wiped away for a flex spending account.
Correct.
And with all these savings accounts, for most people we help, I think the ones that are most successful are the folks that automate the process. So in other words, if you're going to contribute to your 401k, literally make the contributions every pay period. You don't even think about it. Or for IRA contributions, do it once a month or once the very beginning of the year. Automate. It really makes it a heck of a lot simpler. We all have enough on our plate on a day-to-day basis. So if you can automate it, you don't even think about it. Plus, too, I think during times of market stress, when we are going through temporary declines, it's a great way to stay disciplined, keep investing, and having the ability to buy more investments on sale.
Yeah, Josh, you're great at this. Josh's office is pretty much completely bare, but there's one quote on the wall. I'm not sure who said it, but it is, simplicity is the ultimate sophistication, and I think that's a good point to simplify this process too. All right, I think I'll move on to our final, last but certainly not least. Our final resolution is to get organized around your financial goals. Talk about intimidating sounding resolutions, but really this one's fairly simple. Goals drive everything. They determine what you're saving for. They determine why you're saving it. And really, it's just a process of setting your intentions and figuring out what you want to do, perhaps between now and retirement, what you want to do for your children's education. Do you want to buy a vacation home? Do you want to travel the world in your retirement? It's just setting intentions. And we usually have clients separate this into short-term, medium-term, and long-term to help make it a little easier to digest. But it's the real first step here is to just get organized, which can be more daunting than the actual goal-setting process sometimes.
You know what's interesting too, Victor? The organization part is, I think, in my opinion, without a doubt, the most important part. It's amazing how many people we sit down with that just getting on a piece of paper their assets, their various accounts, their income, their debt is such a beneficial experience. Just before the holidays, we sat down with a young couple, and just going through the organizational process, hadn't even put together the plan per se.
Yeah, we hadn't even done anything yet.
Right.
Yeah, exactly.
But just organizing really opened their eyes and is leading us down a path to be able to help them that they weren't entirely sure it was possible.
Yeah, and this couple was about 45, and I think there's a great benefit in doing it sooner rather than later. It's always a beneficial process, but we do it oftentimes with our clients who are about to retire for the first time, which they would have been able to alter their situation 20 years ago a little bit easier than doing it just at retirement for the first time. So I guess the sooner the better is my point there.
Right. We try and make it really, dare I say, fun. Can you make financial planning
I think
fun?
It's fun.
It's not like going to the dentist, or at least that's what we like to say.
Well, a lot of people do dread the process or just thinking about getting started with it, but once they're done with it, they're often so happy that they did it, and it feels like a huge weight has been lifted.
All right, so Andrew, what's the best way for us to get started?
I think the best way for you to get started as a listener here is to just sit down, have a conversation, with your spouse, your family, your loved ones, and just think about what's important to you. What do you want to accomplish for those short, medium, long-term goals? If you're closer to retirement, start to think about what you want your retirement to look like. How are you going to spend your time now that you're not going to work? So these are the kinds of goals that you should get out a piece of paper, the old-fashioned way. Just start writing some down. Just brainstorm, see what you like. And really also think about, is there anyone in your family, kids, other loved ones who should know more about your financial situation? Start thinking about any legacy planning that you'd like to start to do. It's never too early to begin thinking about things like that.
Okay, well, I think we've covered them. So our 5 suggested resolutions for this year, just to review briefly. Good time to figure out what you're spending, but really, to Josh's point, figure out what you're saving. especially if you're still earning income. Number 2 is take a look at your cash flow for the year and figure out if you have any gaps for this year's spending that you need to bridge. Third is cover your risk. Number 4 was make sure you're taking advantage of those tax advantage savings vehicles, both retirement accounts as well as some of those advantaged healthcare or even educational savings vehicles. And then number 5, last but not least, is sit down and finally get organized about your financial goals. So if any of this sounds good, you'd like to hear more, we do this all day with our clients and we're happy to help. This has been Josh Jones, Andrew Busa, and Victor Colella from Advisor Investments, and we're all thanking you for listening to another Advisor You Can Talk To podcast. If you've enjoyed this conversation, please subscribe, review our show. You can also check us out at advisorinvestments.com/podcast. We really love your feedback, and oftentimes we'll receive suggestions from listeners to do episodes for a specific topic. We really enjoy getting those suggestions because, we can talk about this stuff all day long, but we'd rather talk about what's valuable to you. So if you have questions or topics you'd like for us to explore, please email us at info@advisorinvestments.com. Thanks everyone for listening.